Hi to all. So in this video, we will cover the collar strategy, and you will see that this is basically a simple strategy in which we have three positions in our portfolio. So we have a long position, which is a stock, another long position, which is a put option, and a short position, which is a call. And by a short position, I mean you're writing that call, so you're selling that call to somebody. And we will follow basically the same steps we have followed before. Step one, get the intrinsic value. Step two, get the profit of the portfolio or the stock in this case. And three, adjust for the contract size. So we already know how to get the intrinsic value for the call option, right? It is just max of the stock price minus the strike price, and the strike price is given here, K price, right? And let's keep in mind that if you're solving this problem in a practice quiz or in a quiz, things are going to be much more explicit than in the spreadsheet where we have all these values scattered throughout the spreadsheet, right? So we have minus the strike price. Let's lock the strike price or zero. Then the put option intrinsic value, we know that it is max of, it is the opposite, right? So it is strike price, and we lock the strike price minus the stock price or zero. So we scroll these two things down. So we're basically getting the intrinsic values. It's not surprising that the call option is getting positive intrinsic value. I mean, it's in the money as when the stock price is higher, whereas the put option is in the money or it's getting a positive intrinsic value when the stock price is lower. So then we have to calculate the profits of our three positions of that comprise our portfolio. The first thing is, well, what is the call profit? And that's the only tricky thing you gotta keep in mind. In the collar, you are writing the call option. So if you think about the profits of this call option per se, because you have written it, your profit is basically the premium that you're charging for it. So you're going to gain the premium, which is given here, and then you will lose whatever the value of the intrinsic value is, right? So we have already calculated the intrinsic value. Before we do this, let's lock this, and then we will lose or we will subtract the value of the call option. And then that's it. You can see that when the stock price is low, you're gaining that premium that you're collecting from writing the call option. But as the stock price goes up, then you are starting to uh, lose money. Now, the if this is an uncovered call or a naked call, basically your losses could be technically unlimited, except that you will be very quickly called to, you will very quickly receive a margin call. But let's keep in mind in the collar you have the stock. So you have the stock. That means that your losses are not unlimited because your losses are offset by the fact that you are the owner of the stock, right? You may have an opportunity cost, but you do not have to go and buy the stock that you don't own at X price. If it's $1,000, you have to go and buy it at $1,000 and then sell it at the strike price. You are the owner of the stock, so this is a covered call that you have, right? So what is the stock profit? The stock profit, if we go to that, so we have already looked at the call option profit. So let's continue with the stock. The stock profit is basically the stock price here. So this is the stock, all the possible stock prices at expiration, and we want to see what are all the possible profits for this portfolio. So we are assuming 75 is the worst case scenario. You could keep in mind, once again, you could start your worst case scenario in zero. Then, as soon as you have that, you will consider this stock price at expiration, which is a hypothetical value, and then you will subtract the initial stock price. Let's log the initial stock price, and now you will have all the possible profits from your stock, from the stock that you're holding, right? Now, if we combine the two things just without the put, okay, this is how a um, covered call basically looks like, right? So you quickly see that you are having losses from the stock that are offset by the premium you're collecting from writing the call option. And then at some point, you have capped your gains basically, right? So instead of having unlimited gains from the stock or unlimited losses from the writing the call option, now you just have that limit of which is your max gain, which is this 23.875, right? But now in a collar, basically, we have the stock, we have a put, and then we have a call option too. And the put, we are long in that put, so basically we're buying that put. So we are paying the premium of that put, which is the put price that is given here, and therefore we are receiving the intrinsic value because we would exercise the put if it is in the money. So let's lock the premium, which is this one. And now let's scroll this down and we would have gains if the stock price is low, but we would have losses. We would lose the premium if the stock price moves substantially up. Now that we have these things, once again, let's keep in mind that the call profit, it's basically the opposite of the profit because in this case, we're assuming that our gains are the premium and we're losing the intrinsic value because we're selling. Here we're selling, here we're buying, and here we're buying, or we already own it, right? And now the overall profit from the three positions is just adding these three profits, and that is the overall profit of the collar, right? So the overall profit of a collar looks very similar to a bull spread, and we just need to adjust for contract size the same way we have been doing it before, which is basically multiplying by 100. And as expected, this chart looks similar to a bull spread. Now, we want to compare because in the book you have this in your figure. What would have happened if instead I just invest in the stock? Well, let's look at the stock profits and multiply them by 100 so we can make those two comparable. And let's include them in our chart. So now this completes the same kind of chart you have in the book. Basically, this is the line representing the stock gains or losses, and this is the line representing your collar strategy. Right now, let's just do one small uh, additional test here. Let's look at something quickly. So we started looking at what happens if we have this call that we're writing and what happens if we own the stock, right? But let's forget about this covered call. And this is what our portfolio would look like. So as a matter of fact, I'm going to tell you this, uh, the logic behind the collar, right? So number one, let's assume you have this stock. So you have some losses, potential losses you want to reduce. So next step, you add a protective, you add some a put option for each stock you have, you buy a put option. Therefore, you limit the losses, and this is what we see here in the orange line right now. Let's keep in mind we have just deleted the call option. So we only have the put and the stock in this graph right now. So you have limited the losses from the stock by adding a put option to your portfolio, right? So you have limited losses, but you still have unlimited gains from the stock. Now let's assume you become a little bit greedy. And of course, if you add the put option, you're paying a premium so you can buy the put option and add it to your portfolio. So let's assume you decide, well, what happens if I write a call option writing a call option, selling a call option, that gives you the possibility of collecting the premium. And let me sell a call option that has a premium that matches the premium of the put. So with the cash I am getting from writing the call option, I am able to pay for the put option that protects me from the downside, right? From downside risk. So in this case, if that happens, then we go back to what we had before. The moment we add this call option that we're selling, yeah, that is right. Basically, you are receiving 13.65 in this case premium for the call, which is completely covering the cost of the put. So you're basically getting the downside protection of the put without getting money from your pockets. However, as soon as you write the call option, then basically all of the upside from the stock, all of the upside that we still had here in this blue line, which is the stock profits, now we are no longer able to get that. So we are capping, we're setting a limit to the upside, which is this limit here. Okay, so once again, if we eliminate the written call option, we have a stock protected with a put option. We have limited losses, unlimited gains. The moment we eliminate the um, cost of the premium, so we pay it by writing this call option. Now we have these three positions: stock, call, and put. Stock and put are long positions. We own them, and we write the call option. Then yeah, we no longer have that cost of the put option, but we have limited the upside too. Okay, so that is the color. So in other words, if you try to get downside protection for free by basically selling that call option and getting that money to offset the cost of the put, well, it sounds nice, but there's no such a thing as a free lunch in finance. So you are giving up something. You are giving up the potential upside from this from your stock. Okay, so I hope this is helpful, and this is basically the color strategy. Thank you for your attention.